Okay, hi everyone. This is going to be the first lecture on chapter 4. Get this guy out of the road here. What are we looking at in this chapter? Well, we're going to be looking at the 1040, an overview, the layout, the structure. Afterwards, we're going to be looking at dependents. And finally, we're going to look at filing status. So as a starting point, right, we're going to try to keep things simple here. We're looking at the 1040, the individual tax return at the federal level. Now, I like to kind of start small and then build out because it can be really intimidating, really quick looking at these things. So I kind of have here baby Mario, big Mario, right? Baby Mario, big Mario. So we're going to start at the baby level, right? You always have to start somewhere. And with this, right, this is very like a simplified version of the 1040, right? And when I say 1040, right, it's this guy right here, page 1 and page 2. So if we were to kind of look at that, dissect it, get it to its very like bare bones, you would start with your income, you would back out your deductions, that gets you to your taxable income. You use this to figure out your tax liability based on the tax rates. You back out any credits and prepayments, and you either be owed money or you owe money. So that's like simple baby version. If we break it out a little bit further, right, these get subdivided. And what I mean by this is our deductions, right, we got to distinguish here between our above the line and our below the line deductions, right, with the line being that AGI. So you have your gross income minus your above the line before you establish AGI deductions. That lands you at your AGI, namely your adjusted gross income. That is to say, it's your gross income adjusted for your above the line deductions. You then back out the greater of the standard deduction or itemized deductions, as well as any QBI deduction. That gets you your taxable income. You use your taxable income, right? For your ordinary income, you go to those tables. It gives you the little formula like the back of a cereal box, like cheat code. You put that information in to get your tax rates. That tells you your tax liability. We will see also, right, you have to bifurcate your preferential income, your capital gains, and your qualified dividends, and separately calculate the tax liability on that, add them together, right? That's the idea of your tax liability. You can have other taxes, so things like self-employment tax, alternative minimum tax, that gets you to the total taxes you owe. From that, you back out credits, right? Credits reduce your tax liability dollar for dollar. You back out any prepayments. Hey, throughout the year, when taxes were being withheld from your paycheck, that's called a prepayment. You send that into the IRS throughout the year, right? The government doesn't wait until the end of the year to get their money. They need it throughout the year to operate. And again, at the end of the day, you either get money, a refund, or you owe money. In an ideal world, right, if you were to talk to like a financial planner, they would say to you that you don't want to get a refund and you don't want to owe. Now, obviously, you don't want to owe because you owe, and furthermore, you could be subject to interest and penalties on top of that. On the reverse side, right, you don't want to get a refund. The reason for this is it's essentially like you're giving an interest-free loan to the government. So at a high level, right, if you're trying to understand why do you get a refund or why do you owe, well, if you get a refund, in short, what happened is you put more into the system throughout the year than you had to. In other words, my tax liability I calculated is $1,000. I put $1,200 into the system. I'm going to get $200 back. I put more in than I owed. Here's kind of showing you that 1040, right? So the idea with this is it's complex. This is just giving you a high-level overview. You have page 1 and 2. Into that, right, you have your Schedule 1, which flows over, your Schedule 2, and your Schedule 3. These guys over here, right, this is where it's getting some of your above-the-line deductions, right, your credits, any additional taxes. It's kind of like if you've ever seen a big giant Excel file and there's a bunch of tabs in it, right, this guy right here is like the front tab, right? It's just like the summary, it's clean, it's neat. But if you've ever seen one of those kind of models or Excel things, you know that there's a lot of back end things, a lot of other tabs that build into that front page summary tab. That's kind of like the 1040, right? It looks not that bad, 2 pages. However, there's a lot of feeder documents that go into that, and feeder documents that feed in to the feeder documents. So again, just keeping it high level here. Don't get caught up in the minutia. You don't need to know line for line every single thing on the form. We're just looking at the blocking and the tackling. All right, when we're talking about the 1040 and we're talking about income, kind of the top line item there, you have to be able to distinguish realized from recognized income. Now, they sound almost identical. What is the difference? Right? Well, realized income is essentially whenever you have a change in economic position. It's kind of like economic income. In distinction, recognized income is that realized income that you recognize or place on the return. It's taxable income. So like economic versus taxable income. Most of the time, your realized income is going to be your recognized income. By way of example, you make $100 at your job. Hey, I realized $100. I will recognize $100. In distinction, right, you can also realize income but not recognize it. And this is when you would either exclude it or defer it. So muni bond interest income, right? We realize $100 of muni interest. It's an economic income. However, we exclude all of that. In other words, we don't recognize it on the tax return because there's a provision that lets us do that. Similarly, deferral, what's going on here? This is kind of like kicking the can, right? We're not going to recognize the income in the current year. We're going to kind of kick the can, punt on it until a later year to recognize it. All right, working our way down the return here, right, with gross income is a broad concept. It's generally worldwide income. So, you live in the US, you're a citizen, you make money, I don't know, in Germany, you got to include that on your US tax return. Again, we talked about here realized versus recognized, and then we gave some examples. When you don't recognize, you exclude or defer it. So you can look at those. What are some examples here, right? So exclusions and deferrals, muni bond interest, gifts, right? If somebody gives you a gift, you don't have to pay federal income tax on that. Alimony post 2018, right? The person who receives it, that's not going to be income. Gain on the sale of your personal residence. So, hey, you live in your primary residence 2 of the last 5 years. If you have a gain from the sale, you can exclude that. Generally, life insurance proceeds, if you're the beneficiary, there are some modifications to this, but general rule, life insurance proceeds are excluded. And then for deferrals, we'll see this at a later point in time. We have things like installment sales and Section 1031 like-kind exchanges. Again, with these situations, we have an economic event. We say we're not going to permanently exclude it. We're going to defer it. So we're not going to recognize it in the current year. We're going to punt, kick the can, defer until a later year when we recognize the income. So we're talking about income, right? We realize it, we recognize it. However, once it's recognized, right, we put it on the tax return, not all income is created equal, right? So we need to distinguish the different types or characters of income. Specifically, right, we have ordinary income, which is taxed at normal rates. We have capital gain income, which is potentially taxed at preferred rates, depending on the holding period. And then we have qualified dividend income, which is taxed at preferred rates. And there's a holding requirement for that as well. Specifically, ordinary income is kind of the general basket, right? It's often known as like earned income, but it can include some passive items. So like just basic interest, for example, would be ordinary income. But the idea here With ordinary income, it's taxed at ordinary rates. And what we mean by that is you go to the back of the cereal box, the little chart, that tells you those progressive tax rates and how to calculate it. In distinction, right, you have capital gain and qualified dividend income. These receive, if the certain criteria are met, preferential tax rates. And what I mean by that is, hey, your ordinary income, right, you may have to pay 37% tax on, but your capital gains and qualified dividend income, you may only pay 15% tax on, right? So you make money at your job, 37%, you sit on your butt and you get capital gains, 15%, right? Active, passive, these are going to be the exception to the general rule. Now, capital gain income, this is essentially from the sale of capital assets, namely non-business assets. Traditionally, it's things like stocks and bonds, but it could be anything that's a non-business asset. So you sell your car, you sell your couch, right? You sell your Pokemon cards. Assuming you aren't in the business of doing this, these would be capital asset transactions. And the idea with this, and we'll talk about the specifics later on, but if you sell long-term capital assets and you have a long-term capital gain, that's going to be taxed at a preferential rate. So if you hold it for more than a year, sell it at a gain, preferential rate. A year or less, at ordinary income. Likewise, we have qualified dividend income. And what we mean by qualified dividend income, it's essentially when we own certain U.S. corporation stock with a certain holding period, and it pushes out dividends. Again, if you have this 0, 15, 20% tax rate, what determines if you have 0, 15, or 20%? It's a function of like your other income, right? So if you make a lot of income, you're probably paying 20%. If you don't make much, you're paying potentially 0%. That's like, because you'll see that a lot, 0 to 20%. What dictates that? What's your other income? How much you make? But again, the idea with these, general rule is going to be ordinary income, but capital gains and qualified dividend income, those are going to receive preferential rates. All right, next thing here, we need to kind of talk about our deductions. So we said, hey, we have two types of deductions, above the line and below the line. And when we say the line, right here, that's really just a way of saying AGI, adjusted gross income. So with our above the line deductions, sometimes known as 4 or 2 AGI deductions, basically if you qualify for them, you get them. We'll have a whole chapter on deductions, so don't worry about the specifics here with the minutia of ABC deduction, things like that, just the framework here. In distinction, below the line deductions, these are established after AGI. In other words, they're from AGI. You take away from AGI. And really the big thing here is like whether you itemize or you take the standard deduction, which we'll talk about, but there's also a QBI deduction that you get on top of that. Here's kind of the idea, right? You have taxable income coming at you. The name of the game from planning perspective, you want to reduce your taxable income. So that's what deductions do, right? They're getting rid of your taxable income. So with regard to above the line deductions, right, these are generally anything that occurs that's a deduction before you establish your AGI. So it would be the expenses on Schedule C and D, like student loan interest, if you have a traditional IRA contribution. Again, we'll talk about the specifics later on. Afterwards, right, once you get AGI, the next thing is, right, it's like Ichabod Crane. You got to have your fork in the road. Are you going to take the standard deduction, roughly, $14,000? If you're single, it's a flat amount, right? Everybody gets this automatically. Or are you going to itemize? And when we say itemize, this is just like a series of deductions that you add together, total them, and compare to your standard deduction. So like A, B, C, D, add them up. Is that bigger than my standard deduction? Is that smaller? Right? I'm always going to try to pick the bigger of the two. On top of that, right, you also get the QBI deduction. At the end of the rainbow, if it's perfect, 20%. What's the idea of this QBI deduction? High level, in the Tax Cuts and Jobs Act, they reduced the corporate tax rate potentially from 35 down to 21%. To mirror that benefit, flow-throughs, S-corps, partnerships, they also were like, hey, what are you doing for us? So they gave them this QBI deduction, which is essentially if you have income from like a partnership, an S-corp, or a sole proprietorship, you can get a deduction for potentially up to 20% of that income. But here's kind of the standard deduction versus the itemized, right? It's like you get a flat amount versus what do you qualify for as itemized, add them up. In this case, right, standard deduction's bigger. It could be possible, right, the standard deduction was lesser. In other words, you would itemize. What happened here? Before tax reform, this was like always a pretty close call, right? You'd be like, well, I don't know if I itemize. I don't know if I'm going to take the standard deduction. One of the ways and one of the things they did in tax reform was they tried to encourage everybody to take the standard deduction. They made it very big, and then they gutted a lot of the itemized deductions. So that was, kind of a way to simplify the tax return. So, right, here's it just showing you, right, the above the line, the below the line. Here's showing you, like, where you would see it on the actual tax return itself. And then this is just kind of giving you an overview here, like in words, of comparing, that like the initial kind of baby Mario, big Mario. We have our income minus our deductions gets us our taxable income. We multiply that times the tax rates. We can have additional taxes like AMT or self-employment tax. End of the day, you're going to get at your total tax liability. You back out from that credits, right, as well as prepayments. And when we talk about credits, right, these reduce your taxable or your tax liability dollar for dollar. In other words, all else being equal, a credit is normally going to be more powerful than a deduction, right? You can kind of think of it like a deduction, right? That's a function of how powerful it is, the tax rate in play, right? So if I give you a $50 deduction versus a $50 credit, all day, every day, you're going to want to pick the $50 credit. Why? It's saving you $50 in taxes, right? Whereas a deduction, the power of that is a function of it's dependent on the tax rate, right? So when you run the math, a deduction is only going to save you $5, whereas the credit's going to save you 50, right? So it's kind of like a coupon, right? This coupon right here, a deduction, right? It's a percentage coupon. You save 10% on your purchase, right? It's like you're shopping at Kohl's. You get the infinite Kohl's cash, keep coming back, percentage, percentage, percentage. In distinction, right, a credit is like a coupon that's like you save $5, you save $10. It's a dollar amount. So you can think of a deduction like a percentage savings, a credit like a dollar savings, two different types of coupons. Again, at the end of the day, where do you ultimately land? Well, the idea with this is if you owe taxes, right, that's kind of the frowny. If you get a refund, that's kind of the smiley, right? But we said it probably should be frowny, frowny, right? You want to break even. So and this is just showing you kind of those prepayments and things like that. Let's look at a couple quick examples here. All right, so we got two taxpayers. They want to know what's their gross income. Looks like they have corporate bond interest income and two salaries. That's great. We're looking at $130,000. The idea with this is the muni interest, we would exclude that, right? Kirby kind of puffs it out. It's excluded. The character, right, this is going to be ordinary income. In other words, we don't have any long-term capital gains here. We don't have any qualified dividends. It's ordinary, general rule. You can look down there, kind of at the other variations. This guy right here, this is just saying, all right, we said we had 130,000. We're going to take an above the line deduction. That gets us our AGI. Okay. Then once we have our AGI, right, then we need to start looking and saying, all right, are we going to take the standard deduction or are we going to itemize, right? A flat amount or add up a bunch of different things and see where we land. Right, well, kind of in the first iteration here, we have 27,000 versus 11,000 itemized. Pick the bigger, right? Down here, right, we pick the bigger, right, greater of 1 or 2. What this is saying down here is, hey, on top of that, you also get the QBI deduction. In other words, it's not pick the greater of standard deduction, itemized, or QBI. No, don't just like label it and throw it all in there. Instead, you get two things. The first thing is the greater of your standard deduction or itemized deduction. And the second thing is the QBI deduction. So don't kind of mix them all together there. Again, here's some other iterations you can look at. All right, this guy right here, what are they showing? Well, they're saying, hey, all right, we have this AGI. We're going to back out the above the line deduction. Up here that we did to land at it, we back out our below the line deduction. There's going to be no QBI in this case, given the taxpayer's facts. That gives us our taxable income on the ordinary income. We're going to use this table down here, right? If you remember from chapter 1, just kind of plug and chug, it gives you a little formula. Accordingly, our ordinary income tax liability on our wages and things like that are going to be roughly $12,000, okay? So there we are, we're going to carry it down. Here they modify it a little bit. They say, hey, on top of those ordinary income, right? Say you had a $5,000 long-term capital gain, and let's just say it's taxed at a 15% rate. The idea with this is you don't throw it all into one bucket and go down here, right? In other words, this guy right here, this table, this is only for your ordinary income. And what you're using is your taxable income, right here. So you're not using your AGI, you're not using your gross income. And when you encounter that non-ordinary income, namely the capital gains and the qualified dividends, you have to calculate that separately. It gives you a tax liability there. Add together the 12 from up here, your ordinary income, based on the table, using the taxable income, with your preferential income, the liability 750, hey, that's going to be our total tax liability. This is just showing you a little simple example, right? We owe this amount, we get a credit, we have withholdings. Hey, it looks like we're getting a refund. We put more into the system than we owed. And here we're getting into kind of dependents and things like that. So with this, we'll end the lecture here. We'll see you in the second lecture for chapter 4.